What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We're going to be covering the basics of options and another installment of our Creative View series. Now, for Creative View, we aim to be able to break down different financial indicators that we may use in our algo trading strategies, right? Being able to get into what makes an AI agent and how it really works, and also get into the nuts and bolts of machine learning. Today, super excited for this option 101 basic, and we're also going to be submitting a trade at the end of this, so I need you to stick around for the full video. So let's go ahead and jump on into this, right? So what is an option contract, right? So we have to be able to start with the basics, right? So an option is a contract that gives us the right, but not the obligation, to be able to buy or sell a stock at a specific price. Now, that specific price is also known as our strike price before a specific date. Now, that specific date is also known as our expiration date. Now, there are two types of options. There's a call option, which gives us the right to buy, right? And we think that the price is going to go up, or we're bullish on the market, right? So when we buy call options, we normally have a tendency to be bullish on the market. So when you hear that term, right, don't think I want you to be able to be comfortable with it now, because we understand that we think that the market is going to go up. Then we have a put option. This is a right to sell because we think that the price is going to go down. So we buy put options. We're bearish on the market. We think that the price is going to go down. So now we're going to be pulling in live prices from the S&P 500. The S&P 500 is the top 500 companies within the New York Stock Exchange. Now, the reason different algo traders or investors or different individuals that are invested in the market like to use it, because it gives us an overall landscape of how the market is doing, right? Because it's the top 500 companies within the market. So when you look at SPY, you can be able to gauge, all right, is the market bullish? Is the market bearish? How are the call options doing? How are the put options doing, right? So we're going to be breaking this down super granular, fam. All right, we're looking at SPY. The current price is 694.17, and the day change is about just under $1, right? Or about 14% if you want it that way. So here's an example of a call option, right? So this is SPY. SPY is going to be the underlying asset. Now here's that specific price we talked about, or the strike price. This is the price that we think that the option contract is going to go to, and we're buying a call, right? So just looking at this, right, this is letting me know that whomever is buying this option contract is bearish on SPY, or they're bearish on the underlying market, thinking that it's going to go up, right? So again, this gives us the right to buy SPY at 694, even if SPY is trading at 694.17, right? And the premium or the cost of this is going to be $88. Why is that? Why isn't it 88 cents, right? For every option contract, and we're going to get into this, but let's just go ahead and cover it now. But for every option contract, there are 100 shares. So in order to get the actual price of what a one option contract is going to be for this call, we're going to take 0.88 and multiply that by 100. Then we're going to have $88. So here's an example of a put contract. Just by looking at this put contract, right, this letting me know that whomever is buying it is a bit bearish on the market. They think that SPY or the underlying market is going to go down, right? So this gives us the right to sell a SPY at 696, even if the SPY drops below that price, and the premium we're going to be paying is $185, right? All right, so let's go ahead and jump into our quiz. So what does the call option gives us the right to do? Does it give us the right to sell a stock at a specific price? Does it give us the right to buy a stock at a specific price, or hold it forever? I wish it was hold it forever. Like, all I had to do was buy a call option. It's like, bro, I could hold you forever, bro. Like, why not? So what do you think? Go ahead and put it in the comments what you think the answer is. Again, is it A, is it B, or is it C? If I could, I would put C, if I could. All right, so what do you think it is? So we're going to go ahead and put B. All right, and when we buy a call option, that gives us the right to buy a stock at a specific price. Let's go ahead and go to our next question. So if we think SPY will drop, right? So we're the market or SPY is going to drop. So what are we? We're bearish on the market, right? So if we're bearish on the market, which option should we buy? Is it going to be a call option? Interesting. Is it going to be a put option? Or either one works? Well, let's break this down. So if we think SPY is going to drop, or if we're bearish on the market, right? A call is when we are bullish on the market. We think that the market is going to go down, right? So it can't be a call. So we can take out A. We can also take out C, right? So that leaves us with a put, because we think that SPY is going to do what? It's going to drop. So we're bearish on the market. If we're bearish on the market, we want to be able to buy a put so we can capitalize on that. All right, beautiful. So now let's go ahead and talk about one of the most important parts of option contracts, right? Is being able to understand the strike price, the intrinsic versus the extrinsic, right? You get this, you get damn near 90% of all options, right? What it is, how it makes sense, and how you can be able to get into the world of being able to trade options. So the strike price is the price that is written on the option contract. The price is where you have the right to buy a call or sell a put activates, right? So memory trick, the strike price is the target price that you're betting around. So the current price of the current price of SPY, excuse me, is 693.76. And being able to understand these strike prices a little bit more with live data, right? So we're going to talk about in the money, at the money, right, and out the money, right? So in the money contracts are contracts that are closer to the current price, right? So these are contracts that are already profitable, right? So these are contracts that are going to be a little bit more expensive out of the three. Reason being so is because they have a lot of intrinsic value. And we're going to talk about the difference between intrinsic and extrinsic, right? So these contracts are already printing money, and these are one-for-one movements when it comes to the underlying stock price and the option contract, right? So at the money contracts, these are contracts that are near the current price, right? Not super close to it, but near the current price. So when it comes to relativity of how pricey it is, these are about second tier, not as pricey as ITM contracts because they're not already at or a little bit further deeper in the money, right? These ATM contracts are going to be a little bit hugging the current price, right? A little bit further up. And then OTM contracts are going to be contracts that are super deep in the money, right? So these are contracts that are maybe 2 or 3 levels up, and everybody has a different school of thought when it comes to like how they're going to categorize OTM. But for me in my house, right, I categorize it as being 2 or 3 levels up from the current price of SPY. So right now SPY is at 693. So 3 levels up would be 696. So anything from 696, right, is going to be OTM. We're going to need a lot of movement in order to being able to profit if we're catching OTMs. OTMs are also called lottery tickets. Reason being so is because they're super cheap in order to get into, but if it does work your way, you're printing money, right? So key insight for a SPY contract of 694, we're betting SPY goes above 694, right? So if we're getting a call contract for 694, we're betting that SPY goes above 694. If we're getting a 694 put contract, we're betting SPY goes below 694, right? So call, we're bullish on the market. We think that the market is going to go up. So that would make sense that we want it to go above, right? A put is we're bearish on the market. We think that the market is going to go down. So again, that would make sense why we want it to be below the current price. So let's get into the bolts of it. Intrinsic versus extrinsic, right? What's inside the option contract? So think of it like a slice of pizza, right? The intrinsic is going to be the real stuff, and the extrinsic is going to be the hopes and dreams, right? So intrinsic is going to be the real money. So this is the actual real profits built into the option contract right now, right? So if you exercise the option contract, this is instant, and this is what we'll get. Simple math, and I want you to remember this because maybe you'll see it later. So intrinsic equals the stock price minus the strike price, if positive, otherwise it's 0, So intrinsic equals the stock price minus the strike price, right? So live look at being able to look at SPY 692, right? This is going to be an in the money contract because if SPY 693, it's already at or a little bit deeper in the money, right? So in the money contract. So we're going to have the current price, the stock price 693.76 minus the strike price, which is 692, and that's going to give us the intrinsic value of 196 or $176, right? So this is instant. If you sell this contract right now, this is how much money you're going to this is how much money you're going to receive if you were to sell this, if you had this particular contract. So in the money contracts they're damn near, if not 80 to 90% super intrinsic, if not all intrinsic, right? Because they're already to or at the current price of SPY, right? And then here's the option price. So the option price is going to be 252. Now the intrinsic is going to be what the real money of the option contract is right now, and then the extrinsic, the hope money, the hope and dreams, right, is going to be time value plus hope, which is 0.76. So the true option price is $252, right? So that's going to be your intrinsic plus your extrinsic. So this is what you pay for the possibility of future movement when it comes to the extrinsic, right? Again, this is our hopes and dreams. This is our time value when it comes to what's actually inside the price of the option contract, right? It is the premium for the time and uncertainty. It melts away as expiration nears. When intrinsic, where does intrinsic value comes from? The time remaining. More time equals more chances to move equals more value equals a little bit more expensive. I should have put that there as well, right? Because the thing we're paying for options, right, is also this time, right? So the more time you have, the more expensive it have, but also the more value, the more chance you have to move, right? When it comes to the time remaining. Volatility, and we're going to be using IV. And the reason we're going to be using IV is because that is specific to the underlying option contract itself. Implied volatility allows us to be able to gauge how how big of a move does the market expect it to be, and also how expensive the contract is going to be. So let's get a bit more into it. The wilder market, more potential, and then more value when it comes to the volatility, and then hopes and speculation. People hope for the what if. So a live look at an OTM contract, because OTM contracts are not going to have intrinsic value, right? As we see here. So let's look at it. The current price of SPY, so OTM of 694, right? So the current price of SPY, is 693.76. The strike price of 694. So intrinsic is going to equal the stock price minus the strike price, and is going to be negative or zero, right? It can't be negative, so it's just always just going to be zero whenever you have it can't work out, so we're just going to default it to zero, right? So OTM have zero. I want you to remember this. OTM contracts have zero intrinsic value. So the option price is the intrinsic. There's nothing there yet because it has to move, right? It has to go from OTM, ATM, then ITM, right? It has to do that song and dance, right? So if we're starting here, right, we have to go from OTM, ATM, then maybe you're start making at the ATM. Maybe you can start making money at the OTM, right? It's depending on how big the move is, right? Then ATM, then you're really printing money at the ITM, right? Right. So intrinsic is 100%, or OTM contracts out of the money contracts is 100% extrinsic values, right? 100% hopes and dreams. So big takeaway is ITM contracts have real value, right? Real value plus some time value for ITM contracts. ATM contracts, right? Small or no intrinsic value, mostly time value. And then OTM contracts, out of the money contracts, 100% time value, pure speculation. As expiration approaches, extrinsic value approaches zero. That's also called theta decay. We'll get into that a little bit later, right? So only intrinsic value remains at expiration. So let's go ahead and jump into our quiz. And after our quiz, I also have something supplementary in order to really understand the intrinsic and extrinsic, because I know sometimes that can be a bit difficult in order to grasp. So we're gonna go through one more exercise in order to get it. And we're gonna be looking at live data. So let's go through our quiz real quick. So SPY is priced at 694. Before I do this, you know what I should have done is get a whiteboard up, because what I want us to do is actually go through our work here, fam. We're going to go through it step by step, right? So we can actually work this out, and that'll be dope. Man, options 101. All right, beautiful. Let's do this. Let's do that. I'm going to come back over here. All right, beautiful. So SPY is priced at 694. A call 690 call is which type, right? So let's come back over here. Let's go to our board, right? And let's work this out, right? Based on what we know, right? So SPY is at 694. So this is, let's go ahead and expand that a bit. 694. So SPY. So this represents the current price, right? So if we have a call of 690, what type of call contract is this, right? So remember the school of thought, right? For ATM, OTM, and ITM, right? So for ATM, we're going to have contracts that are current price is 693, right? ATM, these are contracts that are at the current price, right? Or just under it, right? ITM or in the money contracts are at the current price of the SPY, right? Or a little bit less, right? So as you see, current price is 693. 693 and 692 is already in the money contracts, dollar for dollar movement. And OTM contracts are 2 or more levels down, right? So if the current price of SPY is 694 and we're buying a 690, we're buying a what? So would it be in the money? Not really, right? Because in the money is the current price of SPY. If the current price of SPY is 690, we're buying 694 and we're buying 690. So it's not going to be ITM, right? Is it going to be ATM? Maybe, right? So let's think about it. ATM is at or near, right? So it's $4 away. So not really. So the only option that we have left is going to be OTM. So let's go ahead and put C, not V, but C. Why? The strike price is 690, which is below the current price. If the strike is greater than the price is OTM, but if the strike is less than the price is ITM, excuse me, in the money. Who's in the money, fam? The price, I'm sorry, I explained it and then I got the answer. That is hilarious, isn't it? It is ATM. I told you it was less. If it's 694, it was less, right? So that's why it is ATM. The strike price is less than the price is ITM. So it is ITM, not OTM. SPY is at 693. And we have a call, a 680 call, which is priced at 450. What is the intrinsic value? All right, so let's go back to our whiteboard and being able to break this down. Let's go to our whiteboard. I feel like that is just obnoxiously big. Let's come here. So let's go grab our equation so there's no confusion. Let's grab our equation so we can break this down. Right? So here's our equation. Our equation is saying the option price equals the intrinsic plus the extrinsic, right? All right, bet. So how do we calculate the intrinsic? The intrinsic is calculated by the following equation. So let's go ahead and bring this over. So intrinsic equals the stock price minus the strike price, right? If it's negative, if it's positive, perfect. If it's negative, it's going to be 0. So we have the current price current price of SPY is 680. So stock price is 683 minus the strike price 680. Strike price. We should make this different color, son, so we can like really push the point in. Let's make this orange, and we're gonna make this purple. All right, beautiful. Strike price 680. Please listen to me. For favor, thank you. Strike price 680, and then this equals $3, and that is the intrinsic value, right? So let's go ahead and change the color there. So we got how we did it. So we did the stock price, which is the 683. They told us what the stock price was, right? The way that they're trying to confuse us is throwing this, it's priced at 450. Really don't need to know if it's priced at 450, right? So what we're saying is that the stock price minus the strike price, throw you in here to trick you up, and then we have $3, right? So this is the intrinsic value is $3. So let's go back. Do we see $3? We do see 3. Let's go ahead and put B. Look at that. Intrinsic equals the stock price minus the strike price, and we're going to have $3. The remaining 150 is the extrinsic value, right? So they threw this 450 in here to be able to trip us up. I mean, you could use it in order to figure out the intrinsic value, but if we already have a straightforward equation, let's use it and move forward. All right, bet. So an OTM contract, OTM, right? OTM has what? OTM has no intrinsic. It is all extrinsic. So an OTM contract is priced at $50 or 0.5. What is the intrinsic or extrinsic value, right? Is it 0.25 intrinsic, 0.25 extrinsic? Is it 0.50 intrinsic, 0.0 extrinsic? Or is it C, 0.0 intrinsic or 0.5 extrinsic? Well, it told us the answer in the question. It's OTM, right? OTM, we know, has 0 intrinsic value. So it has to be C. All right, beautiful. So what I want to do now is I want to bring in a sub lesson that we're going to really get into the nuts and bolts and being able to do this values calculator, right? So clear, Python run. So again, to be able to really hit the point home, ITM, option contracts have real value right now. The stock call, the stock price is above the strike price. For a put, the stock price is below the strike price. ATM stocks at, ATM is stock is right at the strike price. Mostly time value, small intrinsic value. And then OTM, out of the money, options have 0 real value, all extrinsic. The call, the stock price is below the strike price. It needs to go up. And then for a put, the stock price is above the strike price. It needs to go down, right? So what we're going to do, we're connecting to Schwab or Thinkorswim in order to pull in real stock data, real call options and put options, so we can see the different ITM, ATM, and OTM and see how the intrinsic and extrinsic value is going to work, right? So which one do y'all want to start with? Let's go ahead and start with NVIDIA. I think they're always cool to look at. So NVIDIA is currently priced. That is, let me just triple check. I'm like almost certain. Don't do that. Don't be that guy. Don't be that guy. We're Gucci. NVIDIA's current price is 185, right? So the current price is 185. So if we're doing a live analysis, right, an ITM in the money contract, a strike of 181, it's going to cost us $500, fam. $575 in order to get into this contract. $4 of it is going to be all intrinsic. 175 is going to be the extrinsic, right? So we have a 70-30 split here for the in the money contracts, or ITM. For at the money contracts, this is going to be a strike price of 184. It's going to cost us $360 in order to get into this ATM contract, or at the money contract. The intrinsic value is going to be $1, and then the extrinsic value is going to be 260. So as you can see, as we progress along this ladder here, we're getting less intrinsic and more extrinsic, right? So we have a 28-72 split here. And then OTM, completely out of the money contracts, right? A strike price of 186. The premium is going to be $244. Yes, it's the lesser of the three, but we have no intrinsic value baked in. It is all extrinsic, right? We need 344 in order for us to be able to break even. And at the bottom here, we need 260. And then for ITM, or in the money contracts, we need 175. So of the three, yes, OTM is the least expensive, but we need a lot more movement in order for us, in order to break even, right? So the ITM contract is $4, is real value, lower risk, more stable, most valuable, already profitable if we exercise this right now, right? The ATM contracts is popular for traders, good leverage, is not too risky. And then the OTM contract, if exercise OTM, you lose everything, pure speculation. Remember, extrinsic value decays as expiration nears, right? So let's look at another ticker symbol. Let's look at QQQ. QQQ is the top 100 tech companies within the NASDAQ. So QQQ's current price is $625.30. If we were to get an in the money contract, it is going to be $621. It's going to cost us $500, and we only need $75 in order to break even. It has about an 85-15 split when it comes to the intrinsic and extrinsic values, right? An ATM, or at the money contract, is going to be $624 strike price. It's going to cost us a little bit less, about $228, right? We need not that much of movement, about $98 in order for us to break even. A 57-43 split, so it's not that bad for an ATM contract. And then OTM contract is a strike price of $624, have a premium of $90, a lesser of the three. First one under $100, but we need so much more movement in order for it to move, right? So we understand the point here. All right, so let's go back to our main lesson. So expiration date. Expiration date is going to be the countdown clock, right? So this is the specific date of what is an option contract. Remember, we talked about this before. What is an option contract? An option contract gives us the right, but not the obligation, to buy or sell a stock at a specific price, right? That specific price is going to be the strike price. That's what we just talked about. And now we're going to talk about that specific date. The specific date is going to be the expiration date. So the expiration date is the last date that the option is valid. After that, it disappears, expires worthless if OTM out of the money. So memory trick, the expiration equals your options countdown clock. So here's a quick breakdown, right? Current date is the 13th. So if we were to get an option contract that expires today, this is going to be a 0 DTE contract, right? So these contracts expire today. These move fast. These are the contracts that we normally trade, are 0 DTE contracts, right? Reason being, so this is just my philosophy, right? Why do I want to wait to the end of the week if I can get paid today, right? And then when you have weekly contracts are contracts that expire on the Friday of the week. So you probably get it on Monday, Tuesday, right? You have until Friday in order for that contract to expire. And then we have bi-weekly and then monthly contracts baked here as well. So one thing that you want to be able to keep in mind is that the more time that we have, right, the less theta decay that's going to happen. What is theta decay? Every day for your option contract, right, it loses value. Or every minute, if you're doing 0 DTE, right, it loses value, right? So the more time that you have, the less that you have to worry about theta decay, right? And the more time that you have in order for a move to move on your side, all right? So let's keep going. Shorter expiration, cheaper, fast moving. These are 0 DTE options. I don't want to say gamblers, but hey, these are 0 DTE contracts. A longer expiration, these are more expensive and more stable, right? So time is always working against you for option buyers, and that's called theta decay. All right. So 0 DTE, these are what kind of option contracts? These are $0 to enter. I wish. If I just had an idea, it's like, all right, bet I want this option contract and it costs us nothing. Why not, fam? Right? Or do we have B, 0 days to expiration? This expires today. That sounds familiar. Or do we have C, 0 delta theta exposure? So what does 0 DTE mean? So let's go ahead and put B. Why? 0 DTE is 0 days to expiration. These option contracts expire today. High risk, high reward, fast action. Like a 60-second car or 10-second car. Yeah, Fast and Furious, like, oh, I want a 5-second car. That's like a 5-second car. And weeklies are like a 60-second car, maybe a 30-second car, and monthlies are a 60-second car. All right, let's get back into our work. What do you think if you had to compare a 0 DTE option contract? What kind of car would you compare it to? Right? For me, I want a Skyline, a Nissan Skyline. That's what I'll compare a 0 DTE option contract to. Right? It'll get you places, but you better know how to drive it. So what would you compare a 0 DTE option contract to? So which option contract costs them more if everything else is equal, right? Is it an option contract that expires within a week? Or is it an option contract that expires within a month, right? Or is it they cost the same? Well, let's think about this. With options, right? What is the number one thing that's working against you for options? Theta decay, right? So if you have more time in order for the option contract to work in your favor, right? Wouldn't more time be more expensive? So an option contract that's 1 week compared to one that's 1 month, the one that's 1 month is definitely going to be more expensive as opposed to the one that's 1 week, because we have more time in order for us to be for the move to go in our favor. So it's definitely going to be the one for one kind of 1 week. So now let's go into implied volatility. Implied volatility or market vibes, right? Implied volatility measures how wild the market expects the stock to move. High IV or high implied volatility, we expect big swings. Low IV or low implied volatility is a calm market, right? So memory trick, excuse me, IV equals market vibes, spicy vibes equals expensive contracts or expensive options, right? So currently we have the IV chain sitting at 29%. Right, this is super elevated. The market is nervous right now. It's on pins and needles. It's trying to figure out what's going on. Is there something that we should be cautious or worried about, right? So currently the market is sitting kind of expensive, and option contracts are going to be a bit expensive in order to get into. Now we're going to have IV, excuse me, by strike price, right? So if we so you can see it varies. So the highest we see is 16.8 and the lowest we see is 14.97, right? So trader insight, high IV, these are option contracts that are expensive. This is a good time to sell options, right? So if you're selling puts, this is a good time for you to be able to collect premiums, right? A low IV, these are option contracts that are super cheap. Good time to buy contracts, right? Buy options. After earnings, one thing I want you to be able to understand, if you don't remember anything else, remember this, right? But I think you would. I think we did a great job. But nevertheless, let's keep going. After earnings, right, there's something called IV crush. Options lose value even if you're right. Because what is earnings? Earnings is when the underlying company is letting us know how it performed for the particular quarter, for the particular month, for the last 6 months, whatever time frame they're reporting earnings for, right? So if the company is reporting earnings, they let us know, hey, you know what? Instead of making $1 billion, we made $5 billion, right? So we made an extra $4 billion, and this is where it came from, X, Y, and Z, right? Or the company could did, all right, instead of making $1 billion, we made 200 million. Well, yeah, that's crazy. Still made 200 million, but whatever. And this is why we didn't make the 800 million, right? So earnings is being able to let the shareholders, investors, or whomever that is interested in the underlying company, what was the performance, right? Now, what happens before earnings? You're going to see IV spike. You're going to see IV get stupid crazy, right? Option contracts are going to be stupid expensive. Now, because we're expecting, all right, we're on pins and needles. What's going to happen? Is the company going to do well? Is the company going to fold? Is there going to be somebody going to be fired? Right? This is like high level press conference, right? Or high level or high tension, high level area when it comes to these earnings, because you're going to have the CEOs go on Squawk Box and all these other shows to be able to say justify their earnings reports, right? So for those 5 to 10 hours, right? Maybe for a little 24 hours for that cycle, for lack of better words, right? Earnings are going to matter. So that's where we're going to see that IV spike. Then after earnings, everything flops. All right, back to normal, back to regular business, right? So even if you're right, that's why you're going to see the option contract kind of take a dip there. So company XYZ is reporting earnings tomorrow. What happened to IV? Right? So they're reporting earnings tomorrow, right? So what is everybody doing? They're on pins and needles. They want to be able to. All right, what's going on? What's up? So what's going on? Are you making money? Are you losing money? Who's getting fired? Who's getting hired? Right? I'm going to do you later. So just sit right there. So IV drops because earnings are predictable. IV spikes because big moves are expected, or IV stays the same, right? Remember, we talked about this. Everybody's on pins and needles. We're expecting something to happen, right? Market is expecting a big move. So that's why that's why options get a little bit more expensive before earnings. After earnings, the stock moves 2%, but the option contract lost value. Why? You picked the wrong strike? Maybe. IV crush, volatility collapse after the event, or the market is rigged. Now, everybody thinks that. Everybody thinks that. Maybe it is. Maybe it isn't. Maybe I'm an agent for them. I'm just shitting you. All right. So what is earnings, right? What do you after earnings, the market the stock, moves 2%, but the option lost value. Why? It's because of the IV crush. Even if you guess right. Fam. You get crushed by that IV. So high IV options are blank, so it's a good time to blank. So high IV option contracts are cheap, so it's a good time to buy them. Interesting. High IV contracts are expensive, so it's a good time to sell them. I think I heard that before. High IV contracts are free, so it's a good time to collect them. Bam, I wish. If all I had to do was, hey, you know what? This IV is kind of high right now. Run me that. If all we had to do is that, why not, big bruh? All right, so it is going to be B. All right, now we're going to be going over the Greeks, right? Going over delta, gamma, theta, vega, and rho. So the Greeks measure how an option price changes based on different factors. These are your risk management dashboard, right? So memory trick, Greeks are your option sensitivity dials, right? So here's a live look into delta. Delta is going to be the probability of profit, or how much the option contract moves as opposed from a dollar movement. Gamma is going to be how. Matter of fact, let's just go into it instead of me having to break this down. So what each Greek tells you is delta. Remember, it's going to be the dollar change per $1 movement per share. So the delta of 0.5 equals 0.5 a share times 100. Why is there 100? Because there's 100 contracts per share. So for every $1 movement, we're making $50 a contract. So if SPY moves $2, we gain $100, right? Because for every $1 movement, we're up 50. So SPY move 2, all right, bet I'm up 100. Does that make sense? Delta also tells you the probability of profit, right? So if we have a delta of 0.5, that lets me know that's probably an ATM, or like getting close to ITM contract. Remember, an ATM contract is a contract that is near the option, the price, right? This is getting a little bit more nuts and bolts into it. So we have a 50% chance of this contract being able to expire in the money, right? So delta tells you two things, which is the probability of profit, and this is 50% that this contract has an opportunity to be able to expire in the money, or it tells you the dollar change per $1 move per share, right? So gamma is going to let us know how fast delta changes. This is your speed boost, right? So high gamma, delta loves that, as delta grows as the stock moves your way. So here's an example. delta of 0.3 goes to 0.5, goes to 0.70 when we have high gamma, right? So that's why these are primarily the three that we're going to be interested in. The other two is good to know, right? But primarily you're going to be focused on these three. And theta is going to be the dollar amount lost per day. This is called time decay per share. So theta of negative 0.05 times 100 shares, because there's 100 shares in every option contract, is going to be $5 lost per day or per hour or per minute, depending on which day's expiration you picked. So the clock is always working against you when you're buying options. So Vega is going to be the dollar change per 1% IV change per share. So Vega is 0.10 times 100. Why is it 100? Because there's 100 shares in every option contract. I feel like that's gonna stick by the end of this video. So a $10 per option contract per $1 IV move. Critical before earnings. This is where your IV crush definitely works in play here. And then row, like really don't have that big of an impact, but it's good to know. Row is going to be the dollar change per 1% change in interest rates. This really did matter when we're in the environment. Will they, won't they cut, right? Back in 22, 23, maybe a little bit of 24, right? Usually minimum impact for short-term interest rate environments, right? So here's the priority guide for day traders, and this is where I sit. 0 DTE to 1 DTE contracts, we care about delta. This is the direction, right? And gamma, this is going to be how fast we're going in that direction. And then theta is going to be, and it's depending on how you're managing your position, but theta is how much money you're losing, right? For swing traders, it's going to be theta because this is how much money you're losing per day. Delta, the directional exposure, and then Vega, which is the interest of the IV changes from earnings. And then long-term traders, 30 monthly contracts, you get semi-annual, yearly contracts, right? Vega, theta, and then delta. So let's go ahead and jump into our quiz. Your option has a delta of 0.5. SPY goes up $2. I think I've seen this before. How much does your option gain per contract? So 0.5, just delta. Is it $50 delta times the $1 move times 100? Or is it $100, right? Delta times the $2 move times 100 because there's 100 shares in every option contract. So we know delta is letting us know two things, right? Delta is letting us know the probability of profit, and delta is also letting us know how much in dollar moves will the option contract go per $1 movement, right? So if the option contract went up $2, for every $1, I'm getting $50, right? So if it went up $2, I'm getting $100. So that's C, right? Beautiful. Theta of negative 0.5. What happens to your option contract overnight? Does it gain $5? Little mine. Is it B? Does it lose $5? Right? Or nothing. Theta only works during market hours. I wish. Right? So it is going to be B. It loses $5. You do 0.5 times 100 is going to be the $5 that you're losing per day. And the next question, you bought an option contract before earnings. The stock moved your way, but you lost money. Why? Bad luck. Market is random. Is it really though? IV crushed. Vega killed you after earnings, right? Or is it C? Theta decay worked too fast. Maybe it's a combination of B and C. Like I would accept that too, but it is going to be B, IV crush. You're an option day trader. You day trade 0 DTE options. Which Greek matter the most to you? So 0 DTE options, I care about which direction I'm moving in, right? I mean, theta decay, yeah. I really don't care about the interest rates, right? Because that really is not going to impact me as much. So if I'm a 0 DTE trader, right? If I'm a 0 DTE quant algo trader, I really care about delta, the directional move in which we're going. All right, beautiful. So now is looking at an actual chain, right? Looking at an actual option chain, being able to look at it live from Thinkorswim. On the left of the option chain is going to be your call contracts, and on the right of the option chain is going to be your put contracts, right? So your put contracts is when we think we are what? We are bearish on the market. So we think that the market is going to go down. And then we have our call contracts. These are going to be our bullish contracts, we think that the market is going to go up. So the bid, right, is when you want to be able to, okay, let's think about it this way. When you want to get into the market, right, or when you want to go over somebody's house, what do you, no, not always. Some people are just like, show up. If you one of those, ask, bruh, ask. But before you go over people's house, what do, right? Don't you ask to go over their house? You remember, you used to have those teachers, right? Don't ask me, right? Don't ask me. Little Mercy, don't ask me, ask me. I don't know if y'all ever had those teachers that did that to you, but yeah. That's why I make sure. So when you want to go over somebody's house, right? Don't you ask to go to over their house, right? Same thing. We want to get into the market. We're paying the ask price, so we're asking to get into the market. When we want to get out the market, we're going to be paying the bid price, right? So the ask price is what we're paying to get into the market. The bid price is what we're paying in order to get out the market. And the difference between the ask and the bid price is the ratio or the spread, right? So delta is going to be our directional change. And then theta is how much money we're losing per day. And then implied volatility is going to let us know how wild, how crazy the market is for that particular strike price, right? So 691, we're seeing it costs like $82, right? I mean, anywhere between 200 and 204 for a call, right? And anywhere between 25 and 26. And then when we go to 697, it's going to be anywhere between 418 to 431 for a put. And then for a call, it's going to be, oh, damn near, bruh, this OTM like crazy. All right, so how to read it, we talked about it. Bids when you sell. All right, perfect. Now let's go actually run a trade. What I want to do is we're actually going to demo a trade for y'all, so you can actually see how algo trading works. Here we go. So we're going to run a trade, right? And I'm using Alpaca in order to run this trade. And we're going to do a trade live with paper trading, right? And it's going to be either SPY or QQQ. So let's go ahead and pick QQQ. So what we're doing right now, live, right? Let me go over this. So let's let it happen. So at live, we picked the contract for $27. We're holding it for 12 seconds. We're waiting to see if it's going to be profitable. And after the 12 seconds, look at that. We lost $1. We sold it. So we got in at 27. We got out at 26. So let's go look at what happened. So this is paper trading. We're trading QQQ. QQQ is the top 100 tech companies within the NASDAQ, excuse me, right? The current price of QQQ is 625.48. The strike that we got into was 627. So a bit ATM, OTM, right? The price that we paid was $29, right? But we submitted a limit order, right? So there's two different type of orders that you can submit, right? If you're paying the ask price, right, you're going to be paying a market order, right? So you're sometimes could be overpaying, or sometimes if you're paying the bid price, you could be underselling, right? Well, those are called market orders, right? Now, what I submit are limit orders, right? I'm like, all right, bet you want $28. Here's 28. Take it or leave it, right? Here you want $29, right? Here's 28.5. Do I have any takers, right? So sometimes being able to submit a limit order is a little bit better than being able to submit a market order, right? If you're paying the ask price, if you're paying the bid price, you're paying market rates, you're paying market orders, right? Sometimes you could be overpaying, sometimes you could be underselling. And the difference between the two is called the spread. A tight spread is easy to enter and easy to exit, right? That's also liquidity. We want to be able to have tight spreads, right? Because we want to be able to get in and out real quick. So this is the option contract that we bought. This was a limit order. We bought it at $30, which was a buy to open, right? Now it went into pending status and we waited for it to fill. And then our step 5 is being able to hold the position for 12 seconds once we confirm that it filled, right? We wanted 30, but I actually filled at 27. So we got an improvement. It's like, all right, bet, that's what's up, right? So we waited 12 seconds, and within those 12 seconds, the position moved against us a little bit, right? So we got in at 27. The current price was 26, so we lost about 3% or $1. So we're able to sell it, and here's the order ID, right? We're waiting for it to fill. Then we got our fill confirmation, right? And then look at that, you just algo traded. Let's go do it one more time. Now let's go do SPY. So same thing. We're submitting a limit order, 14 bucks. What do we fill? 11. So we got a little bit of an improvement. Let's see how it works for us. Now we're waiting 12 seconds, right? To be able to see how well we're able to get into this position. All right, bet we lost $1 again. We're trading in the afternoon. I understand. All right, so let's go over this. We're trading SPY. SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. The current price of SPY is $6.93. We were able to get a strike for $6.95. The ask price is 13, right? Bid is 12. The difference is about 1. So tight spreads equals is easy to enter and exit. So that's what we like to see. I submitted a limit order for 14, right? We were able to get filled at 11, right? And then we filled at 11. Now I'm holding the position for 12 seconds. Now, after 12 seconds, this is what happened. We were down $1, right? And after being down $1, it's like, all right, get me out of this. That's 9%, right? Get me out of this position. We closed the position, right? Then after we close the position, here's our P&L or our profit and loss. We got in at 11. We got out at 10. We lost $1 or 9%. So this was definitely cool, definitely creative. If you want more videos like this, I need you to go ahead and smash that like button. I need you to tell a friend or two about this, right? And if you have any other questions, comments, or concerns, please let me know. Oh, before I even get into it, what we forgot to do was go over this option analyzer or chain analyzer. And I want us to do this before we clear it for the day. I think this is super cool, right? What is liquidity? It lets us know, can we get in and out easily? High volume, anything over 100, or high open interest, right? This lets us know that we have liquidity. What is volume? Volume is how many participants we have in that underlying position, right? Open interest is how many individuals that actually bought the contract. So if you have high volume of 100 plus and then open interest of 500 plus, that lets me know that we have super easy liquidity. And then low volume is going to be hard to sell, and we're going to be stuck in the position. And the bid-ask spread is how much does it cost to trade. Tight spreads are less than 5%, less slippage. What is slippage? This is one of the things that always piss me off when I talk about it. Let's talk about slippage real quick. Slippage is the difference between what you pay, what you expect to pay, and what you actually pay, right? For an example, let's say we find an option contract for 50 bucks. Like, all right, perfect. This SPY option contract for 590 calls looking very sweet. So let me go ahead and jump into it, right? And now we're going to be paying 50 bucks for it. I submit my limit order. The market maker comes back to me. I know you wanted 50, but I actually needed $60, right? That $60 or that extra $10, right, is called slippage, right? That's the difference between what you expect to pay and what you actually pay, what you actually got filled for, right? Tight spreads equals less slippage. Wide spreads equals wider spreads. So you're losing money as soon as we enter, right? So that's why we're looking for tight spreads. Implied volatility is how expensive are the option contracts. High IV, we have expensive premium, and then low IV, we have cheap premium. The Greeks is how will the price change, right? Delta is how much money you make per $1 move. And then higher the delta, the more directional exposure we have. And then strike selection is going to be the risk reward. ATM is going to be the balance risk reward, the most liquid. OTM is going to be your lottery tickets, right? It's going to be cheap but risky and can also expire worthless. And then ITM or end the money are going to be expensive. These are dollar for dollar movements because what? They have intrinsic value. So intrinsic value is here, intrinsic value is here, but there's zero intrinsic value for OTM. So let's go ahead and put in a stock symbol so we can actually look at the chain, right? So let's put Peloton, something we didn't even look at before. So Peloton, currently priced at $6.96. This is a 3 DTE, so 3 days to expiration. Chain IV is 29, so high implied volatility. Option contracts are super expensive right now, right? This is good opportunity. Spreads liquid plus tight spreads plus near the money, spread quality, right? So here's our calls, here's our puts, and here's our strike prices. So as you can see, wide spreads is not what we want, right? Wide spreads is you lose money as soon as you get into the contract. So Piton is not where it's at right now. Not going to hold you. So let's put in PTLR. Oh, yes. That's crazy. Let's try one more time. Let's put in Apple. Do you not know how to spell PPL? AAPL. Thank you. Here we go. And this is what we want to see, right? We want to see tight spreads, right? Because I don't want to lose money as soon as we get in, right? So we want to be able to see tight spreads. That's what's up. So you see tight spreads. And this is 3DTE, just like Piton, but we're seeing tight spreads and not wide spreads here. So I can appreciate that. So let's do it one more symbol before we call it a wrap. Let's do USO. That's USO is the United States oil, right? That's interesting. And as you can see, super wide spreads. You probably just want to stay away from this. Super wide spreads. Well, all right, fam. It is your boy Kreative. We did go ahead and break down options 101. So at this point in time, you should definitely know what an option contract is. You should understand the difference between intrinsic and extrinsic values, how we use Greeks, right? And how you can be able to understand and build your own algos for yourself. So we're going to be building on this work, right? So if you do have any other comments, any other questions, please let me know. But in the interim, I need you to smash that like button. I need you to go ahead and subscribe. It is your boy Kreative. I'll be back at it again with another episode.